Phil Chronican, thanks for joining us. Now, a 14% drop in your net profit, below market expectations. I guess a double whammy of the remediation costs with those low interest rates.
Look, it's been a very difficult year, as I think everyone understands, both for the industry, but also for NAB in particular.
Yeah, this is the third bank result.
Indeed. And we've taken over $2 billion worth of remediation charges this year, and we're having to deal in a very low interest rate environment, and that has negative impact on bank profits.
You've announced a 16% cut in the full-year dividend. You talk about cycles, but really for shareholders, this must now be structural, isn't it? The days of high fees in wealth are over. You've got new capital requirements. I mean, surely shareholders can't expect to ever return to 100% payout on dividends, can they?
Well, I think, the structure of banking is changing, and we need to adapt our businesses around that. So we've had to obviously reduce the dividend, which I appreciate is quite disappointing to a number of our shareholders, but we need to get it to a level that's sustainable so that we can make sure we can be clear with our shareholders the level of income they can expect from a bank share, and make sure that we retain enough earnings to be able to deal with the issues that we have to deal with.
Having said that, Phil, your shares are up. Now, that could in part be about your management of costs and what you're saying about cost management going forward. But performance-wise, is NAB now over the worst? Have you reset the slate, as it were, for incoming CEO Ross McEwan?
Well, we've certainly tried to. I don't want to declare complete victory, because there's always issues to deal with in any large business. But we've made a point this year of wanting to address all of the issues of the past and make sure that we're addressing the future. And clearly, with Ross McEwan coming in here in the beginning of December as our new CEO, we want to give him as clear a start as we can and give him the opportunity to help build NAB back into the bank that we think it should be.
You yourself are moving from CEO to chair. You're headed towards an AGM. Now, last year, the first strike against the board's remuneration report was the largest protest vote of any big company ever. Are you confident you won't get a second strike?
Well, that'll be up to the shareholders. They're the ones who get to exercise their vote. All I can say is that we've done everything we can to make sure that we are transparent with our shareholders and are managing the bank as professionally as we can. And what that's meant is that we've made changes to the remuneration scheme, because that was one of the factors last year. Last year there was concern that we'd not listened enough to the shareholders about the amount that we paid to executives.
So what have you done for bonuses, that sort of thing?
So two things. We've, for some of those people last year, we've actually taken back some of the deferred compensation that was awarded last year. And in addition to that, this year there'll be zero in terms of short-term variable reward for the senior leadership. You
are the business bank. Business is your biggest division. Now, you've had growth in your SME business, and indeed you said there's growth to be had. There are challenges, though, out there. What are they? Is it about business confidence? Is it about regulation?
Look, it's a combination, because I think the policy uncertainty, some of the macroeconomic concerns, but also regulation, both on businesses and on banks, are what's holding back business investment. And what we've been saying is that low interest rates have done as much as they can do. We need to look at what are the other issues that are holding businesses back from investing. Yeah, and we're very much aligned around that.
You've actually said that government fiscal stimulus is all very well, but actually even your own banking code and also the government's responsible lending laws present quite a problem.
Well, we're talking about those things that are putting, I guess, slowing the process down. And there's been a lot of regulatory change over the last couple of years. Much of it's well-intended, and I'm not arguing with what's being sought to be achieved, but it's added a lot of process steps, it's added a lot of compliance activity, and that has made it harder for us to get loans into the hands of our customers.
But what needs to change?
But also, can I just go on and say one other thing, which is our business customers themselves, they're looking at the regulations that affect them, and they're looking at the policy settings that affect them, and they're uncertain. So what we're talking about today is we want to get behind our customers and help them address what are the issues that are stopping them investing, and then look at our issues and say, well, what can we do to be better at meeting their needs by providing credit support? So it's twofold.
Is it that they can't use the house when they're looking to borrow, or that they might like to be judged on their overall cash flow and their income can be very lumpy?
So there are issues. I mean, the Code of Practice puts a whole lot of additional steps in when people give guarantees, and a lot of businesses, as you'd appreciate, take director guarantees or family guarantees. That process is now more complex. Yes, when you put up the house for a small business loan, you've got to look at the responsible lending obligations that go with that, so that's slowed the process down. But as I said, it's also about making sure our businesses are confident to want to borrow in the first place and making sure we can help them drive the demand for borrowing as well as the supply.
On the consumer banking side, your mortgage growth was quite disappointing, but you're expecting better, are you?
Yes, we had a good first half. We had a weak second half. In fact, the home loans book went backwards in the second half. But towards the end of the second half, we had some good positive momentum. So we've been looking again at all of the things that get in the way of our people supporting customers who want to borrow to buy a house and trying to make that work. So in the last few weeks of the year, coming into October, we've had some pretty good weeks in terms of new lending, but we've got to wait and see that flow through the book.
Now, obviously, there have been 3 rate cuts, which I think have cost you about $200 million. How is your message getting through to customers as to why you can't pass the full RBA rate cut through?
I think we've had this debate in the public for a long time, but obviously as interest rates come down, there's a limit to how much we can reduce deposit interest rates. So we reduce the rates to our borrowers, but we can't reduce the rates to depositors because in many cases the rates are already very low and there's no real basis for taking them below
Do you think
zero.
the message is getting through?
Well, I don't know, but the more opportunity I have to pass it out, the more it's there. So even though, in the eyes of some people, when we didn't flow through a whole 25 basis point rate reduction, they think that we're holding it for ourselves. Actually, we're losing as well. Our shareholders lose money out of that equation. Because we're putting real pressure on the deposit book. So bank profitability is challenged in a low rate environment.
The other challenge is the amount of Tier 1 capital that you're being asked to raise. Now, you've announced your dividend reinvestment plan today. Some thought there might be a separate capital raising, but you are comfortable that you will achieve easily the 10.5% limit.
Yeah, so we ended the year just below 10.4. With the dividend reinvestment plan and the underwriting of that today, that'll take us, once that's complete in the next month or so, that'll take us to about 10.75, so well ahead of the 10.5 that APRA was requiring.
Now, what are you going to do when the New Zealand regulator, who obviously feels that Australia won't bail them out if there were a banking crisis, what are you going to do if the regulator comes down with much stricter capital requirements on its side of the ditch, and indeed not just capital requirements but other restrictions?
So the other requirements are to operate the organisation so that it can be separated and run standalone. So we've got that in train. We're planning to meet the requirements there. The consultation that they put out on capital was to have a significant increase in capital for banking in New Zealand, and that's been a consultation, and we're expecting them to respond to all of the feedback they've had in December.
But it might lead to you lowering investment in New Zealand, you've basically said today.
Well, I think what we have to understand here is that if you, as their initial proposal put it, if you double the amount of capital required to support banking in New Zealand, then actually there'll be less of it. It won't be just us lowering our investment, there'll be less demand for credit in New Zealand. So we need to look at how that would play out. But the Reserve Bank of New Zealand has been open to conversations around over what time frame these issues might be phased in, what instruments might apply. So I think it's a little stark just to say that capital is going to suddenly double. That's not the way I think that they are envisaging this happening.
Could you see a scenario where you ever sold the Bank of New Zealand to the government's Kiwi Bank, say?
I'm not sure Kiwi Bank has enough money at the moment themselves, but look, I don't think that's a realistic prospect. The Bank of New Zealand, as you should have seen in the result, actually the Bank of New Zealand has been a very solid performer for us. So despite all of the issues in New Zealand, actually those businesses are our business anyway is growing and it's profitable. So we like that business a lot.
Phil, you've worked as well at ANZ and at Westpac. I just wonder what you make of Joe Healy, the former head of business banking at NAB, also behind the new disruptor bank Judo. He talks about bankers becoming like car salesmen with sales targets in his book. He says that banks should be broken up and they've lost the craft of banking and the ability to read customer risk. What do you think of his comments?
I've known Joseph a long time, but I'm not that close to his experiences. Obviously, he was here at NAB, and we did our own assessment of the cultural failings and the issues at NAB, and we published that in our APRA self-assessment document this time last year. So I don't think breaking up banks is what the Australian economy needs. I think the Australian economy does need strong banks, and banks that have the risk absorption capacity that our large balance sheets hold. But I think what we've identified in our self-assessment document is that there are some cultural issues that needed to be addressed, and they do cut to remuneration, and they do cut to the way people see their role and the incentives around it.
So you see this very much as under new management, yourself and Ross McEwen, Phil Chronican and Ross McEwen, new team, new management.
New challenge.
New team, new challenge, and Ross and I have had obviously a large number of conversations, and I think we've got a good alignment around the type of bank we would like to build.
Phil Chronican, thank you so much for your time.
Thanks, Tikki.